Howdy, Jacob here. Today we're looking at Carrier Global Corporation in the building products industry. 57 billion market cap on 71 billion enterprise value. I don't think I've heard of them. They provide heating, ventilation, and AC, refrigeration, fire security, everything HVAC, refrigeration, fire security. That's insane. What a huge company. This is why I love it. I love researching companies. So you always get to see stuff that maybe you haven't heard of before, and this is one of them. For a company that big, very interesting. 22 billion market cap, or sorry, whoa, 22 billion enterprise value. I already said market cap. 17.8 billion 6 years ago, so not a whole lot of growth there. Margins are okay, high 20% on the growth side, low double digits, 11 12% on the operating side. Decent return on invested capital. If we average this out, you are looking at probably low teens, so not bad. They did just start to pay a dividend though, which means less money going towards that reinvestment at possible high rates of return. Let's look at the balance sheet first. We did see a lot of debt. So $10 billion cash on hand, 2.8 billion in short-term debt, 14 billion long-term debt. So net debt, round up, maybe $5 billion. I mean, really not a concern. Yeah, they do have a good amount of debt, but they have a lot of cash on hand. So unless they're thinking about buying, ooh, maybe that's what this balance sheet goes to 2023. Okay. So what I'm seeing here is they went into debt to fund an acquisition, and so their debt is going to be pretty heavy. And it is pretty heavy. That's why we see this enterprise value that much greater. I was like, I don't see 15 billion net debt, but now I do. So they're going to have to 15 billion now in relation to their, maybe 1.8 billion in free cash flow is a good amount. Not it's over 5 times for sure. So we're looking at a good amount of debt, and we don't know whether this acquisition is really hitting their bottom line heavily. I mean, if you buy a company for $11 billion, you sure want to be getting at least $1 billion. I mean, it could be making you more efficient, but really buying it for getting $1 billion extra in free cash flow would be a big plus. And right now, we don't really know. So we're gonna have to make some assumptions on our end. And classic me, I'm gonna be pretty conservative on my assumptions. Overview. Let's go to make our assumptions again. So on the revenue growth side, I think I feel pretty comfortable, maybe 5%. I'm going to do a lower P because, again, they have a good amount of debt now. And I have to focus a lot of that money on debt reduction. Maybe even at the end of 7 years, you're probably still looking at a 10 billion plus enterprise value above your market cap. For margins here, I don't like that. Earnings are greater than free cash flow. Maybe we'll do 11 and 9 with a share change of, have they been buying back shares? Not a whole lot outside of 2021 and 2022, and their dividend currently pays out 625 or roughly 30-40% of free cash flow, and it's a 1.2% yield. I don't want them necessarily increasing that dividend. I think that's fine for them right now. I want, basically, this is saying that about 10% of, or this is even 5 to 7%, whatever, of free cash flow going towards buying back shares to offset stock-based compensation, 30 to 40% for the dividend, 30% or so on the debt reduction, and then leaving about 20% or whatever it is on getting 5% growth a year, 11 and 9% margins, and due to acquisitions, reinvestment. And we're saying the company's stock price needs to fall 66% to get to the return we're looking for here. So again, I don't like companies that make these huge acquisitions where I don't know whether they're advantageous or not. Obviously, I could do more research, but I'm not going to waste my time if a company's stock price isn't obviously cheap for me. There's too many good companies out there for me to waste my time on it. So I hope you enjoy the video and have a great rest of your day. Thanks.